that we're going to talk about. Let's get into them. First, interest rates are basically they're the cost of money. They're charged by a lender to a borrower, which is when you borrow money, your bank charges you interest, or when you deposit money and you receive interest, you're technically charging the bank. The interest paid you for the use of your funds is a charge to the bank. I always advise people when it comes to interest rates, go ahead and check your credit card statements, make sure you're sitting down. Now, what are interest rates based on? Where do they come from? How are they calculated? They're based on the idea of the required return, or as we like to call it, what would a rational investor expect for the use of her money? Now, the required return starts with something called the risk-free rate. The risk-free rate is based on U.S. Treasury securities, because U.S. Treasury securities are backed by something called the full faith and credit of the United States government. The U.S. government has the authority and the power to both levy taxes and declare war. So the thinking is the U.S. government would never be in a position where they would be forced to default on their obligations. Therefore, U.S. treasuries are assumed to be zero default risk. Now, since all other investments pretty much do carry risk, we then add a risk premium to this risk-free rate, and that's how we come up with the idea of the required return. So let's look at some of the mechanics to constructing interest rates. First off, there's the idea of simple interest. You earn money on the original fund invested. However, you do not earn money on the interest earned. So the simplest example I could give you here is that if you deposited $100 and you were earning 10% and you had the money at interest for 10 years, you would earn $200 after that 10-year period. You'd have your $100 original investment, and then you'd have 10 interest payments of $10 each. So technically you'd earn $100 in interest and have your $100 of original investment. Compound interest operates differently. Under this mechanism, you earn money on all funds, so you do earn interest on interest. And we see that same $100 at 10% for 10 years under a compound interest rate structure would have a closing balance of $259.37. And as Dr. Einstein noted, compound interest is technically the eighth wonder of the world, with those who understand it earning it and those who don't paying it. And I always thought he looked like a pretty sad dude. I guess if you spent all that time with all those great thoughts in your mind, I guess you'd look pretty sad and worn out too. All right, so let's think about what are the things that drive interest rates. And there we've got the legendary Vin Diesel and the late great Paul Walker from the Fast and Furious. So, interest rates yielded by any investment take into account several components: the risk-free cost of capital and inflationary expectations, the level of risk in the investment, and the cost of the transaction. So if you think of these, it's sort of like a menu, and you're picking items or you're including items, each of which have a cost, and when you factor them all in, you've got your interest rate. So, holy formula, Batman. Here's this same thought expressed in a formula. So the nominal interest rate, or the stated interest rate, is composed of three elements. The first would be the risk-free rate, as represented by U.S. Treasury security. It would also include inflationary expectations. The idea there being that Treasury securities, when their interest rates are calculated, take into account inflationary expectations. You would then add a risk premium based on how long the borrower would want the money and how likely it is that the borrower would default. And so think about it. Think about two friends you've got or two relatives you've got. The first is extraordinarily fastidious, does everything on time, completely reliable. And she asks you, hey, can I borrow $50 till next payday? And you're like, sure. You loan her the $50. Next payday at like 5:30 p.m., she's on the phone with you. Hey, I've got your $50. Do you want to meet and, get a bite and I'll give you the $50 I owe you? No worries. You never had to think for a moment that this person would go bad on you on this debt. On the other hand, we've all got that friend or relative who is, let's just say, a little bit more carefree about life. And, that person's like, hey, can I borrow $50? And you're like, well, okay, when can you get it back to me? I don't know, I guess in a month or something. Month comes, no money. 2 month comes, no money. You finally have to go catch up with him as he's playing Call of Duty, and you gotta, hey, can I have my money? And eventually maybe you don't get paid back. So there's no difference in the scenario I just described and in commercial banking. It's essentially the same thing. How likely are you to not pay me back is the number one thing that loan officers are trying to evaluate. And then finally, there's a liquidity premium, which says that if there's a difficulty converting the asset to cash or in getting cash from the borrower, we're gonna factor that in. So consider loaning money on real estate, where real estate is a tangible asset. It's worth quite a bit of money, but if the bank has to foreclose when someone's not paying a mortgage, it's going to take them a while to actually have to sell the asset and convert it to cash. And they may have to discount the price of the asset in order to get their cash. That lack of liquidity forces them to get a higher rate to compensate them. All right, so now let's talk about the term structure of interest rates. You can see here in our graphic, we've got the normal yield curve, convex, upward sloping. We've got yield, or the interest rate, here, and then we've got maturity here. And so the simplest and most important interpretation here, under normal conditions, as time goes on, as people borrow money for longer periods, the rates go up. And this is no different. Think about borrowing money for a home mortgage. 30-year mortgages are at a higher interest rate than 15-year mortgages. So longer maturity equals higher yield, based on the idea of the risk of default. Let's say a 30-year versus a 15-year mortgage. That is an extra 15 years of what ifs. What if you lose your job, or what if this happens or that happens? So the lender wants to be compensated for that, and what they'll do is they'll charge a higher interest rate. And then finally, as I said, this is the normal yield curve. The yield curve can also be inverted, where the shorter maturities are higher than the longer maturities, which indicates that the market has an expectation for rapidly increasing inflation. And so they're saying, hey, if you give me back my money in the short term, I'm going to be going into a very, very high inflation environment, versus in the long term, hopefully things will stabilize. Now, there's three theories used to explain the term structure of interest rates. The first is the expectation hypothesis, which says that, long-term rates are higher because they're determined by what the market expects in the short term, plus there's the application of a constant risk premium, and that's why long-term rates are higher. The second thought is liquidity premium theory, and that the long-term rates reflect investors' future interest rate assumptions, similar to expectation hypothesis, plus investors simply want a premium for holding long-term bonds, for tying up their liquidity. Finally, there's the segmented market theorists who say, you know what, there's no real relationship. Rates are simply determined by supply and demand. The person or the institution who need 3-month debt or 9-month debt or 1-year debt vastly different than those that are looking at 20 and 30-year debt. They're not substitutable. It's simply the supply and demand for those particular maturities that determines what the rates are. Now, of course, rates are affected by inflation. And we've got two types of inflation. We've got cost push and demand pull. So let's look at the first. All right, cost push, getting it pushed in. Under this scenario, production is at full capacity. There's no slack in the system. We can't make any more of products. However, costs rise. Let's say that a key component, let's say a key element goes up. I just read an article today that they're saying one of the issues with making electric cars is that the batteries require a large amount of a metal called cobalt. And cobalt, while not excessively rare, is not exactly abundant and is difficult to extract. And so they're thinking that the cost of electric cars is going to go up if the supply of cobalt if we can't find a better way for getting cobalt. So cobalt is a really important input to electric battery production. Let's say the cost of cobalt spikes. Well, the costs of producing electric cars are going to go way up. Companies are going to potentially produce less, and supply will drop. Some companies will simply stop producing them because they don't find it profitable or they get just pushed out of the market. The companies that stay in the game will choose to charge more. They're going to pass that cost of raw material on to the consumer. In comparison to this, we've got demand pull, and he pulled it over. And I just love animation. That's just me. But in this case, production's actually not at full capacity. However, we see a sudden and dramatic increase in demand. Companies all of a sudden say, wow, holy mackerel, we're getting a bunch more orders. We need to increase spending to be able to produce more. We've got to pay overtime. We've got to run extra shifts, maybe put people on the weekends. Well, if it's going to cost them more money, then they're going to pass that along to the consumer. So in this case, the company was forced to raise prices because one of their costs went up, one of the raw materials basically, and they passed it to the consumer. In this case, the consumers suddenly and dramatically demanded more, which required companies to spend more than they expected they would, and so they again passed that on to the consumer. Either way, it gets passed on to the consumer. All right. So let's talk about the cost of money. We assume people are rational when we're thinking about the time value of money. So what are the rationality assumptions? We say that people have a time preference. If you're holding money in your hand now, that assumes you can do two things. You can use it for current consumption. Current consumption is a sort of a technical way to say you can buy stuff, you can do stuff, you can go to the Dominican Republic with your friends, or you can get a car, or you can do whatever you want. Or you can invest the money, which you would expect interest for that investment for consumption later. So you're putting away money for your first house. That's deferred consumption. You'll use it later. You're just deferring that. And typically deferred consumption is assumed to be greater. You're saving for a greater good. Remember that there's an opportunity cost, though. We usually assume that choices are mutually exclusive. I can go to the Dominican Republic, or I can buy a new car. I can't do both. Companies are often faced with the same thing. We can open a new facility, or we can invest money in research and development. We can't do both. And in the corporate setting, we want to account for the opportunity cost of the foregone choice. We need to say, gosh, if we had opened that new facility, it might have brought us an extra $12 million a year compared to this research and development, which might bring us $15 million a year. Opportunity cost is unavoidable in all circumstances, or putting it another way, it cannot be avoided. In the words of the great Neil from the Canadian legendary rock band Rush, one of rock and roll's greatest drummers and also a brilliant lyricist. If you choose not to decide, you still have made a choice, which is the same thing with opportunity cost. If you choose to forego both, you've still made a choice and you're losing the potential gain you could have gotten. So interest rate levels. The Federal Reserve, our friends in Washington, implement monetary policy. Now, monetary policy is policy that is associated with affecting the rates, largely the federal funds rate. And it's the rate that banks charge each other for overnight loans of federal funds, which are reserves held by banks at the Federal Reserve. Fiscal policy is policy that's set by Congress, and that's usually in the form of tax policy. In the event of an expansionary policy, we use that to try to combat unemployment. We lower interest rates. If the Fed lowers interest rates, banks can borrow more and businesses can borrow more. Businesses that borrow more expand, hence the term expansionary. And when they expand, the assumption is that they will hire more people. If Amazon builds a new fulfillment center in Long Island City, Queens, which is about 10 minutes from where I grew up in Brooklyn, they're going to hire X thousand of people at that center. So the expansion drives employment. On the contrary, contractionary policy is used to slow inflation. And a contractionary policy involves raising rates. You raise rates to discourage businesses from expanding and to get the economy to cool down. And one of the great examples of contractionary policy was during the Reagan era when Paul Volcker, the then chairman of the Fed, was raising rates, as he said, to break the back of inflation. He did it, but rates had gotten to, I think, the 30-year Treasury in 1982. I was just looking at a chart the other day, got to about 14.8%. So you could have gotten a guaranteed 14.8% per year on your money, and people were still really, really scared of that. So, any questions before I keep going? Because I thought I saw somebody typing. All right, I'll keep going. Bruce is there to answer any questions you have. Actually, I've got a question. Am I talking too fast or too slow, or is this the right pace? Is everybody comfortable? Just give me a A-OK or Rudy Toot Toot in the chat. Perfect. I try to be perfect, Karen. Thank you very much. Okay with me. Okay, Diana. Okay with us too. Okay, Karen's chuckling, which is good. Don, all right. If anything, if you need me to repeat something or if something's not clear, just type it in. I'm glad to do that for everybody. And then finally, there's the crowding out phenomena where we've almost overexpanded, and then we have government projects which crowd out private investment. All right, so we've come to the end of the first section, and I'm going to ask everybody to put on their thinking caps. I like to use riddles. So we've got a gentleman who arrived at the visitor's entrance to the state pen to visit this hapless fellow. And the guard stopped him and said, hold it, mister, family only. And the visitor provided this answer as justification. And he said, brothers and sisters, he has none. But this guy's father is my father's son. The guard thinks about it and goes, all right, go in. Why do you let him in? What's the relationship? Grandfather? No, keep going. This guy's father, the inmate's father, is the visitor's father's son. Uncle, there we go. Good job, Samita. Good job, Donna. Awesome, that is correct. It was his uncle. All right. So now we move to section 2, the time value of money. Grandfather's uncle, there you go. First cousin twice removed. You love those stories when someone says, "Oh, I'm related to Taylor Swift. My cousin's cousin is her cousin's godfather," or something like that. It's like, yeah, you're practically brother and sister. Holy mackerel! All right. So the time value of money. Would you agree that money is worth more today than it is in the future? Would anybody disagree with that statement? And I see typing, which is good. Yes, people agree. I mean, the classic example of this, and it is the holidays, so you'll probably hear a lot of this. People, especially, your older relatives, they'll say things like, "Oh, I remember when milk was $1 a gallon," or "I remember I bought my first new car. I was so excited, and it was $2,500, things like that. However, it's relative because salaries were much lower back then too. So the portion of your spendable salary, your net salary after taxes, is probably about the same. So you do that with your kids with the gas prices. I do that with my kids too. I was just driving with my son the other day and I said, I remember when gas was 75 cents a gallon. So I think we all do it. So the idea is that, and there's a representation of my son and his "you only live once" slogan, and if he's got it, he wants to spend it. Although he's been asking me about the market lately, so I'm kind of proud of him for that. So you don't wait. You use your money for immediate consumption, as my son would. Now, what would convince you to wait? The obvious answer: more money. Because the idea is, let's say that I could buy, I don't know, any consumer good. Let's say, um, oh gosh, somebody suggest a consumer good right now. Any consumer good. Don is typing. Candy. I like that. So let's say I can buy a king size Reese's for, $2 at Walgreens. I'd like to know that if I'm going to wait whatever amount of money I get back in the future, I still will be able to get that same king size Reese's package. I want my purchasing power to remain constant. I want to have the full benefit of my financial resources. So if I'm going to wait, I want more money so that I know I can still get the same goods and services as I could have by not waiting. So we want to maintain spending power, no loss of consumption. That's our hedge against inflation. And so what's the use of time value of money? Time value of money allows us to do these analyses that allow us to identify what is the cost, or conversely, the value of waiting. Now, there are specific elements in every time value of money calculation. So we've got PV, or present value, which is money we have now. It's a lump sum, and it's stated in dollars, euros, yen, whatever currency you like. Future value is money in the future, again lump sum, again dollars, euros, yen. N is the number of periods. That's going to be stated in terms of years or parts of year. We can do monthly, we can do quarterly, we can do weekly, we can do daily. It really doesn't matter. We can apply it as it sees fit. We've got payments, which are multiple sums of money of equivalent of amounts stated in dollars or euros or yen. And then we've got the interest rate. And we compound to the future and we discount to the present. Now, TVM problems can be thought of as use 4 to solve 5. You'll be given 4 of these, or at the very least 3. Some questions don't require a payment entry. But you'll be given these, and the idea is you plug in the ones you've got to find the one that's missing. So say hello to your new best friend. Here's your calculator. Now, this is the professional version. It's got the cool, shiny face. But the student version, which has a black face, operates the exact same way. And it's this third row of buttons with our time value of money functions in which we're most interested. So, starting simply, let's say we've got a fixed sum for a single period, and we want to calculate what we would earn after one period. In this instance, simple interest and compound interest operate the same way. So let's try a couple of these, right? So here we would say our future value is our present value multiplied by 1, which would be the identity, right? Present value 1, plus the interest rate. And then for present value, well, the opposite of multiplication is division. So we multiply forward and divide back. But let's look at how it would work. So how much would $777 at 7% interest be worth in a year? Go ahead and solve that. Anybody can take a shot at it? People are like, oh, I didn't know there was going to be an actual participation section. 833.39. Let's see. Holy mackerel. Kaboom. There it is. It's just that simple. Samita gets out in front. Nicely done. Nicely done. Okay. And we see that it's 777 times 1.07. Technically, it's 107% of this amount. Can we work through at least one together? Yes, we'll work through several, actually. So, looking at the next one, what would, again, thank you, Erica. I try to be perfect. So that's 2 tonight, so I'm doing well. All right. So what would be the present value of 925 discounted at 8% for a year? Okay, so let's look at the solution. We would take our present value of $925 and divide it by 1.08, and that would be our present value. So these are the simplest examples, and they don't technically even require that you use the time value of money keys. We're about to do examples where we'll use them, but just as an introduction, these are the most basic, showing here's the operation. So in this case, we multiplied our present value of 777 by 1 plus the interest rate, the 7% interest rate. And we got our future value. And then discounting, we just did the opposite. We took our future value and we divided it by 1 plus the interest rate to discount back to our present. The key thing to remember here, ladies and gentlemen, we compound forward, we discount back. That's an important distinction. So there's some thoughts on problem solving. We're going to introduce the approaches tonight. It's not going to be a complete TVM lecture, but in terms of the expectations on the PA and the OA, we should cover pretty much everything you need to know to solve those type questions. You know, you might feel though you've been mugged by an accountant. Very natural, no cause for any alarm. Please reach out to the course instructors with questions. You need to see these problems, and then you need to work through in the text and do the practice questions in the text. There is a bit of practice involved, so it's not that it'll be perfectly, you'll understand it tonight, but in terms of being able to do it, you're going to need to practice a few times and then get back to one of the course instructors. Any of us would be happy to help you. There's practice problems in the course of study. You don't want to be surprised at the results. In other words, you don't want to be punching numbers into the calculator and go, I wonder what's going to happen here. So the idea is go ahead, keep calm and solve practice problems. And also, I would say some of the practice problems in the course of study are from version 3, and they may be a little bit more detailed than is necessary for this version. So I would say that, there's plenty of stuff available online. There's plenty of stuff in Khan Academy or even YouTube. There are so many faculty from schools all over the country. There's plenty of resources for this, so no worries about practicing. So now for multiple periods, we simply modify the formula by saying we take the same for future value, the same present value, the same 1 plus the interest rate, but then we raise it to the number of periods. And if you remember your order of operations, we do what's inside the parenthesis first, then we do the exponent, then we do the multiplication. The other direction, to solve for present value, we start with our future value and then we divide it by, again, 1 plus the interest rate inside the parentheses, then we exponentiate, and then we divide. Now we're going to go through some examples of these with actual numbers and the calculator, so no worries there. In fact, look at that. It is time to use the calculator. Yay! Okay, Donna, far out. So now, Bob deposited $333 for 3 years at 3%. What was it worth at that time? Let's look at what the keystrokes would be for that. So notice, we would put in 333 and we would make that negative because your calculator wants inputs and outputs. It's dealing with cash flows. So it expects that there are going to be inflows and outflows. So Bob deposited, he laid out $333, and then he had it on deposit for 3 years at 3%. So what was that worth at that time? And I see Bruce is typing something. It's considered a cash outflow, so we enter it as a negative number in the calc. So has anyone tried entering this in their calculator? $363.88. $363.88. I think that sounds pretty good. $363.88. Now, anybody have any questions about that? What you do in the calculator is you enter in 333, you enter 3 and N, and then you enter I, Y, and 3. And Samita is typing, so let's see if she's got a question or... Yes, compute PV. You know what? Let's put the calculator on the screen and I'll demonstrate this. Yes, no, enter will be a challenge. I'm going to put the calculator on the screen and demonstrate this. When that happens, my visibility is a little bit obscured, so Bruce will be answering questions as they come up, but I'm going to demonstrate these so we can see all the steps. Does that sound better? I'm sure that probably does. So let's see, pods, share, add new share, share 10, okay. Okay, so I'm going to move this share pod over, and I know that it's probably right in front of everything. And I'm going to share my screen, which allows me to share the BA calculator. And I've got that. Can everybody see the calculator now? You should all be able to see the calculator. So in this case, we would have done 333 and negative to make it negative, and we would have entered that as present value. And notice the calculator even confirms for us PV equals negative 333. Then we type 3N and 3IY. And then, as you guys astutely asked, we click compute future value. And we get a ginormous number. And why is that? Because I didn't clear out my calculator. which I deliberately did because I wanted to illustrate to everybody. So if you don't clear out your calculator, that can create a problem. So you do second, clear TVM, second, CECE, and then you're good to go. So now, 333 negative present value. Present value equals $333. 3-year term, 3% interest, compute, future value, 363.88. All right. Anybody have any questions on that one? All right. Well, let's look at the next one. I'll stop sharing that for now. And I will hide that. So, then we've got Barb. She won an award of $825,000. You can't see the chat box when you share the calculator. Okay, I'll try to size it down differently. You mean, well, it covers the presentation. Did it cover the whole screen? Let's see, people are typing yes. Okay. All right, I'll size it down to make it not be so ginormous. Okay. I hear you. All right. No problem. So, let's look at this one. We've got Barb. She won an award of $825,000. She'll receive that in 5 years. So the future value is $825,000. She can earn 4.75% on her money. What's it worth today? I'm going to show you the keystrokes, and then I'm going to share the calculator and demonstrate that again. So again, in this case, we put in what the future value is. We can put that as a positive because she would receive that. And then 5 years, and then IY, and then we compute PV. So let me share that again. And I will share my calculator with everybody. And I'm going to size it. I know it's going to look dramatically large at first. All right. Holy mackerel. There we go. That's much nicer. All right. You got a negative. Yes, you will get a negative. And that's a good sign. All right. So we've got a future value of how much? $825,000. Okay. So we've got $825,000 as our future value. And that's going to be received in 5 years. 5 is equal to n. And she believes that she can earn 4.75%. Now notice, 4.75. We enter that as a whole number. We don't do a percent. We don't do 0.0475. That's our interest rate. And then we just say compute present value. And it's 654. And Donna just on the button. Absolutely. Absolutely. All right. So let's keep rocking and rolling. And I'm going to move this over here for now. Okay. Perfect. All right. So this is the minimum she should accept now. Why negative? Because the calculator assumes that if you're going to receive something in the future, you'd have to lay something out here. So in this case, what we're basically saying is, how much would Barb accept to transfer that award? It's like, hey, I'm going to be paid $825 in 5 years. In order for me to sign that over to you, you'd have to lay out $159.71 for me to get me to sign the paperwork. So somebody would have to lay that out so that Barb would transfer that cash flow to them. Does that make sense? Okay. Yes, good, cool. Yes, good, cool. All right. I'm going to keep going, and Bruce is there to answer questions as they come up. I do not have the money yet. No, you do not have the money yet. Precisely, Samita. You're transferring the privilege to step into your shoes, as they say. You're transferring the privilege to be entitled to receive the cash flow. So we've got annuities. We've reviewed fixed sums. Okay, I am doing wrong. You got 667, 2384. It might be, and Mary, it might be the way your calculator is set up. We can talk about that. Okay, so let's talk about annuities. We've reviewed fixed sums, but there's also streams of payments. If there's a fixed amount paid at a set frequency, it's an annuity. If it's paid at the end of the period, it's an ordinary annuity. And if it's at the beginning of a period, it's an annuity due. And these formulas are included on your formula sheet, but I don't advise you to use the formula. I advise you to use your calculator. It avoids transcription errors. Remember, you're using a whiteboard, so if you have to write all this stuff down, it'll take a really long time. And it avoids arithmetic errors. So let's look at an annuity calculation. We've got Miyako, and she's been putting away $10,000 a year since she started working, and she'll enter 35 of those $10,000 deposits by the time she stops working. She believes she'll earn 8.5% that time. 8.5% is the historic return on the S&P 500, considered the market return. So how much will she have when she stops working? So go ahead and enter these numbers now. Let's try this calculation. If you enter 0 as a present value. Now, why is the present value 0 in this case? Anybody have any idea why the present value would be 0? So asking about this question, why would the present value be 0? It's in the future, okay, but think about it differently. She's starting the process now. So is there anything in the account now? No, there's nothing in the account. So the present value is currently 0. And then we would enter n equals 35, IY equals 8.5%, and the payment is negative 10,000. So what would the solution be? Go ahead. And, okay, guys, on this question, if we enter 0 in the PV and we enter 35 in N, 8.5 in the IY, oh, Erica comes storming through. Let's see. Look at that. Exactly. And this is a really, really good example. Don is on it also. This is a really good example of what they say contributing to your retirement plan and starting early is what's possible. So nearly $2 million for Miyako and her family by contributing less than $1,000 a month for 35 years. Virtual Snickles bar, absolutely. All right. So let's look at the next one. You've won the Powerball jackpot, and I know you're happy about that. You've won a $45 million jackpot to be received as a series of 20 annual payments of $2.25 million before taxes each year. You decide that you need cash now, and you call a structured settlement company that may or may not run multiple commercials during daytime television. What is the minimum amount you would accept to transfer your winnings to them if you assume a 5.5% discount rate? So understand, you're asking them to give you a bid of how much they would offer you lump sum right now, rather than you having to wait 20 years to get only $2.25 million a year, only $2.25 million a year, and you're using a 5.5% discount rate. Okay, so the future value, let me ask you a question. Erica's on fire tonight. Why is the future value 0? Why do we enter 0 as the future value in this case? People are typing. I'm going to give them a second. Okay. So I'll just say it this way. At the end of the series of the annual payments, how much do you receive? 0. The cash flow is depleted. It's not like there's going to be a 21st payment. So at the end, there's nothing left. You've received all your payments. You'll receive them for 20 years at a discount rate of 5%, and the payment is $2,250 a year. So when you solve for that, it is in fact $26,888,361. Exactly right, folks. Great work. And if they can offer you this amount or more, you take the lump sum. Otherwise, it's worth it for you to wait for that stream of payments. And by the way, just in terms of curiosity, having had some clients when I was working in New York doing financial advising and portfolio management who had structured settlements, they had royalty streams, and they had legal decisions and and things like that. I actually did work with one lottery winner. The structured settlement companies would use a discount rate a lot closer to 12 to 18%. And so this number would then be around 10 million. So for a $45 million payout, 20 years, they would probably offer you about 10 million up front. Yeah, immediacy is very expensive in a case like this. So now, also, I'll just go through this quickly and then we'll wrap up the time value of money. We could solve for any missing element. So let's look at this one. We've got a case where someone bought 24 acres of land 40 years ago. She spent $12,000. Today, that land, which happens to be outside of Scottsdale, Arizona, was valued at $3.365 million. So what was the rate of return on that land purchase? Well, in order to solve that, we know we want to solve for IY. So we know the present value, what she invested, was 12. The future value, it grew to 3.365 million, and it took 40 years. So what's the rate of return on that? What's solving for IY? I'll give folks a few seconds, but otherwise I'll just put it up just to illustrate. I see typing. Oh, wow, you guys are on it. So yeah, precisely correct. So the compound annual growth rate was 15. So now let's look at the final thing. If we've got different compounding periods, then we've got to you put the units in the same as the interest rate. So your calculator can deal with this. What we do is let's say it's for monthly, we multiply the number of years by the periods per year. So for monthly compounding, we would multiply 12 months times 10 years, 120 periods. And then for the rate, we would divide. So 6% per year, we divide 6 by 12, and that's 0.50%. So that's not 50%, it's 0.50. It's 50 basis points, 1/2 of 1%. And then finally, if the payment goes on forever, we refer to that as a perpetuity, which we simply divide the payment by the rate, or if it's a growing perpetuity, we divide by the payment by the interest minus the growth rate. But let's look at an example of monthly compounding, which I've got it solved here, but Let's talk about car loans and mortgages. They operate on monthly payment schedules, and each payment is amortized. It includes interest and principal. When we take the sum of the amortized payments, we see what it really costs to acquire the asset. And in fact, when you buy a house, they give you that number. That's on what's called the HUD-1 form, which is the full disclosure form that lenders have to provide you. So you're going to buy a new car for $27,500. It's not a crazy car. It's not a Bugatti, but it's a nice car. The finance manager, she's great. She'll give you 9% a year, which is a very fair rate. She'll even let you pay it off over 6 years, so 72-month term. How much is your low monthly payment going to be if you're not putting anything down? Well, we solved that by saying n equals 72. Why? 6 years times 12 months a year, 72 payment periods. The interest rate is 0.75%. 9% divided by 12 is 75 basis points, or 75 hundredths of 1% every month. We start with a present value of $27,500, the sticker price, and we have a future value of 0, because at the end, if we assume that we've made all our payments on time, we're done. They can't come at us for a 73rd payment. It's like, we're done. We satisfied the note. Thank you. Have a lovely day. Well, it turns out that our payment on this car is about $500 a month, a little bit less, $495.70. And that if we look over the life of the loan, we're going to be spending $35,691 for this $27,500 car. So how much did we spend in total interest over the life of the loan? Anybody want to just run that number real quick? How much is the total interest charge in dollars? If the total cost is $35,691, but the sticker cost is $27,500, the difference would be the interest cost. So what is the interest cost here? $81.91. Anybody got a different number? That is, of course, correct, by the way. So just pointing it out that $8,191 of interest, which is a huge amount of money over time. So it adds up. So that, I think, covers it. We also talk about uneven cash flows, which this is also talked about in Unit 5. You won't be asked to calculate this, but it's basically if you're looking at a company that's doing a project and the project has a cash flow pattern with uneven cash flows, what you would do is you would solve for the present value of each of the cash flows, and then you would subtract the total of the present values from the initial investment. And so in this case, this project has a net present value of $124,025. You won't be asked to calculate this. This is done here for demonstration purposes. And that gets us to the end of Module 8, Time Value of Money. And so, an observation, Gollum was shocked but delighted when his financial advisor told him that given the royalties from his film appearances and the value of his extremely small but extremely valuable jewelry collection, a single ring, he could enjoy many more centuries of cave dwelling. And wouldn't that be awesome? Do we have any questions before we move forward? Or melt in lava? Good one, Donna. But he did melt with his precious, so I guess it worked. Does anyone have any questions before we go forward? Everybody doing okay? Happy, smiling, people are good? Seeing comments coming up, so I'm just going to wait. You're very welcome, Baruch. Be well, my friend. Any other questions? And of course, you can always connect up with Bruce or myself. We're in the home stretch now, guys. We only have one more module to go to. Okay, yeah, Anmers, I'll work with you on that. No worries. All right, now before we move forward, our final thought, or one thing I want to do is palate cleanser for the brain, Tom. We've been through a lot, and I need to just kind of help people get reoriented. So please go to your happy place. Take a few deep breaths. And let's look at some positive, pleasant images. Look, a puppy and a kitten. Aren't they adorable? Yes, Donna, so sweet. I agree. If you're not an animal lover, how about a nice seat on the beach looking out at the Caribbean? This is where Ferber makes a crack about living near the beach when I'm here up in the mountains in the snow. So, yep. Yeah, nice smile, Bruce. So, yeah, nice beach under a palm tree. It looks like a Corona beer commercial. Awesome. And for those of you that are more corporeal in your pursuit of pleasure and satisfaction, look at that. Yummy, yummy, gustatory delight, a chocolate fountain with a yummy white marshmallow. Who wouldn't love that? Good, and good for you too. Full of bodybuilding sugar. So anyway, we're just gonna like clear our mind of the numbers and everything, and we're gonna attack this final section. So everybody feel ready to go? You feel centered and grounded? If your health is it is body. Yes, that is true. All right, let's rock and roll into our final section. Module 9. So, as our little guy here says, risk versus reward, right? Yes, you can find me on the appointment calendar, absolutely. As you can find all of the CIs. But yes, Anne-Marie, so you can totally find me and book some time. I'm happy to help you. So, risk is a variation from expected outcome. It could be better or it could be worse. So if we get something different than what we predicted, that's technically risk. Risk is a major consideration in capital budgeting where we compare the returns with the associated risks. Remember, we have to calculate opportunity costs, and investments of higher risk, they require extra time and effort to get information, to research it better and monitor the progress. Therefore, risk requires additional compensation. We've got categorizations of risk tolerance. At the far conservative end, we've got the risk averse or risk avoiding market participant or player. They cannot tolerate uncertainty. This person will take a certain inferior return to the possibility of an uncertain but vastly superior return. They won't take the chance. The risk neutral person is neutral. They'll evaluate things on their merits. The risk loving is like, wait, there's a 1% chance I can get 1% more. I'll still do it. And so these are categorizations of investors or market participants, or could be even business decisions. And then in terms of corresponding assets, we've got a progression that goes from short-term debt at one end to long-term debt, so actual physical property, short-term debt, long-term debt, guaranteed returns, property, physical property, high-yield debt, which is still secured, and then finally equity. Equity is the most risky asset because it's not secured. Equity is simply the ability to participate in expected future cash flows. It's not secured by assets. So we measure risk versus return using a statistic called beta. It determines an investment's return sensitivity in relation to the overall market. Now, you will not need to calculate beta. I just want to be clear on this. It describes the correlated volatility of an asset, let's say a share of stock, in relation to the volatility of a benchmark, generally estimated via the use of a representative index. So we would compare, let's say, Apple stock to the market return. Generally, we'll use the S&P 500, and we'll say, how volatile is Apple compared to the market? If the market goes up, does Apple generally go up with it? Does it go up in the same direction, in the same magnitude? So that's what we're measuring here. It's also referred to by a number of terms. The most important one here is systematic risk. So beta is referred to as systematic risk. Higher beta investments tend to be more volatile and therefore riskier, but they provide the potential for higher return. We're going to talk about systematic risk later. Just remember, systematic risk is measured by beta. There's a whole bunch of type of risks. I'm just going to run through them quickly for you here. There's the risk that if you're invested in an interest-bearing asset, the rates will change. There's the risk that if you loan money, the borrower can't repay. There's the risk that the asset is not liquid and you can't convert it to cash quickly or without a loss in value. There's the risk of just being in the market. A decline in the market could lead to a decline in your investment. Market risk, also referred to as systematic risk. There's operational risk. You just have a bad manager making bad decisions. There's the risk of foreign investment. Foreign markets have political risk. They have currency risk. And again, you don't need to memorize all of these. It's just showing you that risk comes in many forms. And then finally, there's model risk. Many financial instruments were created and evaluated based on the use of models. So they hadn't, in some of the cases, like in the, crisis of '08, they had not really worked with these assets before. They just said, well, the models show that it should be this risky, assuming markets operate in these parameters. When the markets broke out of the boundaries of those parameters, the models were essentially worthless and the risk went off the charts, which was not much fun for anybody. So let's understand expected return. Now, there's a technical way of saying this, which says the expected return of an investment can be computed by multiplying the probability of a given event by the return in that case, and then adding together the products of each case, which I don't find to be a very intuitive description. I would create a table. So let me show you how we're doing that. Notice our table here. We've got three cases. Things are great, things are okay, things are awful. We've got the probability of those outcomes. So we've got the best case, it's 25% likely to happen. We've got the moderate case, it's the most possible outcome, 60% of the time it will be that. And then we've got the worst case. 15% of the time it's going to be really unpleasant. Then we have what the return will be in that case. So in the best case, we'll make 25%. Under the moderate case, we're still doing okay. We're doing 10%. And then in the worst case, now we're really having a rough time of it. We're losing 20%. And this is the example that was given in the course material using these numbers, so you can find it in there and reread it. Now, all we need to do is multiply the probability by the expected return to get the probability weighted return for that case. So we get 0.25 times 0.25 is equal to 6.25. 0.60 by 0.10 is 6%. And then 0.15 by -2 is -3. When we take the sum of these, the expected return for this investment is 9.25%. Does that mean that we will get 9.25 every year? No, it certainly does not. It means that in the long run, if we held this asset for a long period of time, generally at least one full market cycle, however long it takes to go through all of these, then we would earn 9.25%. And the only other point I would make is the probabilities sum up to 1, right? 60 plus 25 plus 15 equals 100%. Because something is bound to happen. The probabilities have to add up to 100% because we know something's going to happen. We just don't know what it is. So that's how we would calculate our expected return. Then we look at variance. We're thinking about expected return. And we say, what's the range of outcomes around that 9.25%? By the way, it's 10:13. We'll be done by 10:30. And then I will be sharing the deck with everyone. I'll put it up here, and then you can all download it, those that want to. So first, important, you're not expected to calculate variance or standard deviation. I know some of you are likely disappointed. You had so much fun with that in statistics. Yeah, okay, Donna. So there is no bad news, right? But understand the intuition behind this. When you're asked to describe something that can produce a range of outcomes, most people would say it varies. So we've got this as a statistical concept that describes the range around the expected return within which an investment return can be reasonably expected to fall. And we use that to measure the degree of risk. If we apply this to the main asset classes, which are considered to be money market, bonds, and stocks or equity, we can build a portfolio that would work for almost any investor and his or her risk tolerance. And then this is an important concept here. Time horizon and risk acceptance or variance acceptance, right? They're synonymous, are positively correlated. All that means is if you've got a lot of time, you can take a lot of risk. If you don't have a lot of time, you can't take a lot of risk. Because if you don't have a lot of time, you can't absorb the possibility that things go really bad and you therefore don't have time to recover from it. So that's all that means. It means that they're positively correlated. Long time horizon, big risk acceptance. Now let's look at how we deal with managing that risk. We've got unsystematic risk, which we deal with by portfolio diversification. So in general, returns among multiple asset classes, they don't move in the same direction at the same time. In general, bonds don't move in the same direction as stocks, as a very broad example. If we create a diversified portfolio, an investor can reduce risk or volatility in her portfolio. Now, let me just talk about this for a second. Let's assume you have a portfolio where you've got nothing but Apple stock. You've got a $2 million portfolio, right? Let's say you worked for Apple for a few years. You were granted a bunch of stock. That stock has appreciated, and it's now worth about $2 million. That's pretty cool. But it's the sum and total of your assets. You don't own anything else. You've got a $2 million Apple portfolio. If Apple does great, your portfolio does great. If Apple does poorly, what happens then? You suffer greatly, right? Let's say tomorrow they come out with a report that iPhones cause some dreaded disease, and suddenly the stock price of Apple plummets. The price of your portfolio might go from 2 million, or the value of your portfolio might go from 2 million to 1 million, or even lower. Now, let's say you took that $2 million Apple portfolio. Why don't bonds move in the same directions as stock? That's a good question. The basic answer is that bonds are considered a secure investment and stocks are considered more risky. And so when stocks are going down, people tend to take their money out of the stock market, and it's called a flight to safety. They go to bonds which have guaranteed returns, and they say, okay, I may not make a lot, but it won't go negative, right? Bonds don't go negative. You have a straight payment now. Granted, bonds can default, but that's corporate. Let's say government bonds. So bonds are considered safer, whereas stocks, as stocks go down, they could go negative. A lot of people during the downturn in 08 and 09 piled all their money into bonds because the market was doing so badly. No problem. And I can talk with you at length about that. You know, we can set up some time. I'm happy to do it. So let's say you took that $2 million portfolio and you kept 500,000 in Apple stock, but you used the other 1.5 million and you bought General Motors and you bought, I don't know, Hilton Hotels, or, you know, just a variety of things, McDonald's. You bought a variety of stocks in other companies that had nothing to do with Apple. Now, Apple goes down. Does McDonald's necessarily go down at the same time? Probably not, right? And so what you've done is you've laid off some of that risk of having that concentrated position. That's what we're talking here. So that's considered unsystematic risk. And if you diversify your portfolio, you can reduce it. This is really different from hedging, which is seeking negative inter-asset correlations, basically saying, how can I find stuff that, you know, is definitely, I can play it on the upside and the downside. Again, that's a longer conversation and not on the assessment, so don't worry about it. And then the idea of the active or passive management. Some people believe that they can pick stocks that will perform better than the market, and so they actively manage. And some people believe that, so that would be the big fund manager in the active space would be Fidelity. And then some people believe there's no way to beat the market. Therefore, you should just own the market, own funds that have a little bit of every equity in it. And then that's considered passive management. And then Vanguard would be the big player in that space. And then finally, systematic risk. If you've ever heard the phrase, you can't beat the system, that's systematic risk. What's it describing? Well, we talked about beta, and beta is how we measure it. We also refer to it as market risk. We talked about that. It's the risk of being in the market. You can't avoid systematic risk because it's market risk. You are at risk when you put your money into the stock market. So this is what investors receive compensation for. This is why investing in equities returns higher than investing in debt, because you're putting your money into the stock market, which is inherently risky. Whereas unsystematic risk, what we talked about, the idea of having our concentrated portfolio, you do not receive compensation for that because you could go ahead and diversify that portfolio and you'd be fine. So that's our final slide. Before I get to something else, does anyone have any questions about what we've discussed so far? Anything at all? If you don't want to ask it here, or you don't, or it comes to you tomorrow when you're driving to work, please send me an email, send Bruce an email, set up time to talk with any of us. I'm going to go through one or two more things, and then I'm going to put the file out here so you can download the deck. But before we move forward, is there any questions anyone wants to ask? I see Don is typing, so nope. Thank you. All right. No problem, Samita. Okay. Again, you don't have to ask them now. You know where to find us. So the final question of the night. It's the oldest riddle known to man. Oh. Okay, Donna. Unsystematic is fixed through diversification. That's correct. Systematic assumes diversification, but it can't be diversified away. Systematic is just the risk of being in the stock market. If you choose to invest in corporate equity, then you're taking on systematic risk. That's why stock pays more than bonds. The return that you receive on a stock investment in a company is much higher than the return that you receive from getting that company's bonds or their debt. That's the difference there. So Donna's typing. Okay, no problem. And again, feel free to email or set up some time. So we have our friends, the Sumerians. They lived thousands of years ago in what's currently present-day Iraq. They made massive contributions to science and mathematics. We still use them today. One of the most notable being the 60-second minute and the 60-minute hour. That was composed by the Sumerians. They also wrote down the world's earliest recorded riddle, and I'm going to lay it on you now. There is a house. One enters that house blind and comes out seeing. What is the house? Take a shot at it. Be creative. Think that there's different ways people can be blind. Don't think just physical blindness. Anybody got any thoughts on this one? No? Okay. School. Which it's funny because that's what they wrote thousands of years ago. That's clever. It is clever. All right. So, feedback is most welcome. You can find me at Frank Sampietro at WGU. I'm now moving a pod over, so it's going to obscure a little bit of it. But you see where it says Files 8, Unit 4 Cohort? You can go ahead and click on that and download, those of you that want the deck that we reviewed tonight. Again, feel free to, make appointments with myself or any course instructor. Don't cram. a little time every night is worth much more than a lot of time for fewer nights. I realize everybody's busy, but generally it would be more helpful if you could spend at least 15 minutes a day in the course material. And thank you for your time and kind attention. I wish everybody all the best. I want to thank my buddy Bruce for doing a yeoman's job of manning the chat and answering questions. I hope this was helpful to everyone. You're welcome so much. You're all welcome so much. Thank you, Bruce, man. You're a gentleman and a scholar. And I'm going to go ahead now and I am going to stop the meeting recording. I'm going to hang out here for at least another 5 minutes